welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest is Michael Jones. And Michael is also a CPA, and he's a partner in Thompson Jones LLP, which is a husband and wife partnership. They are located in Monterey, California. His tax consulting practice focuses on sophisticated wealth transfer strategy, trust and probate matters, and family business transitions. Mike is the CPA that top estate attorneys go to with their tax and litigation problems. He is the author of a new book, Inheriting an IRA. And he also wrote another book called The Guide to Electing Out of the 2010 Estate Tax and Final Regulations Governing Minimum Required Distributions. That was his trial run in publishing. And he's also written Final Regulations Governing Minimum Required Distributions, a special supplement to the Pension Answer book. Mike is the chair of Trust and Estate Magazine's Retirement Benefits Committee. He has been quoted in the New York Times, Forbes magazine, the Wall Street Journal, Bloomberg Financial Report, and others. And he's also spoken widely for tax institutes, for CPA groups, continuing education of the bar and CPAs and so forth. So he's a very distinguished person. I'm really pleased to have him here as my guest. Mike is also an avid prone paddle boarder and surfer, and he told me that he's getting ready to have a little adventure getting together with a group paddling from Catalina Island to the mainland. So congratulations on that, Mike, and good luck.
Thank you.
Take a lot of sunscreen. Anyway, Mike provided invaluable comments from my own book, which is How to Use Roth and IRA Accounts to Build a Secure Retirement. And so I appreciated his feedback related to that. Today we're discussing handling retirement accounts, including qualified plans like profit-sharing plans. Profit-sharing plans, Roth and IRA accounts after a death. As I get into this, I want to caution our viewers, because this is a big topic. So we're only going to touch some highlights. These are very complex tax problems. In some cases, we don't even really know the answers ourselves. We're going to give our best shot. But we want you to be aware of them. You also should be aware there's only 10 states, including California, that have community property laws. Again, we happen to be in California. We are California CPAs. We are not lawyers. Seek qualified tax and legal counsel for your own situation. Mike, thanks again for joining me today.
Thanks very kindly for having me.
Okay, here we go. So have there been some recent changes in the tax laws that you think are going to affect planning for retirement accounts?
Well, some relatively recent ones. For the larger accounts, we have this thing in this country called an estate tax.
Okay.
So if you die with too much stuff, the government wants some of it. It used to be that as early as the beginning of the 2000s, we were roughly being able to die with $1 million, $2 million for a couple without having to pay estate tax. And now we have much bigger numbers. Mm-hmm. It's per spouse or per individual, it's $5,340,000. It's going up with the CPI every year. Mm-hmm. So that means you're talking about something close to $10.7 million that a couple can have without paying an estate tax. Mm-hmm. When it comes to using that, the alternative to that often is you might want to use some of that exclusion amount, what it's called. There's a credit that goes with it, but it's like just having an exclusion amount.
Right.
To pass assets to the next generation, the spouse kind of gets, well, it does get to use it, but it's not really included in the spouse's estate. They're called bypass trusts or credit shelter trusts or exclusion trusts.
Right.
And so it's a way of using the exclusion so that it's not in the next estate of the other spouse, but the kids wind up getting it, or whoever in the family you want to have take that. Mm-hmm. It's great to use for things with property that you believe will go up in value. It's commonly used for homes or investment portfolios. It's commonly not best to use them for individual retirement accounts except Roth IRAs. And here's why. The retirement accounts that aren't Roth IRAs are subject to income tax.
Right.
So that dilutes the value of what's going to the next generation. And with required minimum distributions, it's going to be taxable sort of on a scheduled basis. So it's not a real good bet economically to do that. So fortunately, the other thing that we got in with the present tax law we now have is instead of using the exclusion, I can create a way of giving my spouse rights to property in a way that gets my estate tax, my taxable estate, the ability to reduce my taxable estate through a marital deduction. And when I do that, it uses less of my $5.34 million exclusion amount.
Right.
And it doesn't get wasted. I can actually have my executor pass that to my surviving spouse. So if the only thing I had was an IRA and it was worth $5.34 million and I gave that to my spouse, I can also give her my $5.34 million exemption so she can die with 10.7 and she won't have to, there won't be an estate tax on that.
Right. So, yeah, this is a major development. Actually happened, was it early last year, wasn't it? When the Congress was keeping us in suspense about what was going to happen with the tax laws. But before that, this thing that we call the DSU or the
It's called portability, the exclusion amount.
portability.
Yeah.
This was not a permanent provision before, and so we didn't know whether we were going to be able to plan on it being there. Now it's been made permanent. So this is really a major development.
To the degree that tax laws ever are permanent, yes.
Yeah, it really helps to plan.
Yeah.
Okay. I guess another thing that I want to point out is this 3.8% tax on net investment income, and also I guess you could say the compression of the tax rates when it relates, particularly related to estates and trusts.
Right.
So now if you just got like over $12,000 of taxable income in a estate or trust, suddenly you're subject to the maximum tax rates if the trust has income.
And the tax that you're referring to there is, there's a tax on what's called net investment income,
yes.
which is a 3.8% Medicare tax that goes on top of the income tax. And it doesn't really kick in till you get to certain levels. So for a couple, it's like, what, $500,000 or something, or it's quite a bit. But for a trust, it's only $12,000, or for an estate, it's only $12,000. Now, the distributions from a retirement plan are exempt from that tax by law,
Right.
but it's still taxable income. So it can push the income high enough that the other investment income will be subject to the tax.
Right. So we just want to point out that, these developments, again, talk about them with your own tax advisor. Okay. Mike, why don't you tell us a little bit about what is stretch out and why should a beneficiary consider using the stretch out for an inherited retirement account?
Well, being 6'3", I have a great appreciation for the term stretch out.
Oh, there you go.
Because retirement distributions are taxable except for Roth IRAs, the time that we would like to pay taxes is usually when, Michael? Sooner or later?
Later, I think.
Right. If you talk to the chief financial officer of any Silicon Valley firm or anywhere across the country or in the world and ask them, when would you like to pay your bills, including your tax bill, the answer is later. Mm-hmm. So what stretch out does, it's a shorthand term for what are called minimum distributions or required minimum distributions. And that basically says that rather than having to take all the money out at once, I can take my retirement plan distributions out over a life expectancy from an IRS table that can be, for a grandchild, 50 or 60 years, or for a surviving spouse, quite a few years. So that gives us the ability to pay that tax bill later. In the meantime, you make money in two ways. One way is that you tend to be in a lower tax bracket. Why? Because a larger tax distribution, a larger taxable IRA distribution is going to tend to put you in a higher tax bracket. Stretch out lets you have smaller distributions, relatively speaking, which tends to keep your taxable income in a lower tax bracket. So number one, you benefit by getting a lower effective tax rate over the lifetime of all those distributions. The other way is that when you don't pay your taxes until later, the government doesn't charge you any interest on the taxes that you're going to pay later instead of sooner. So it's very much like the government is giving you a tax-free loan that you get to invest in your IRA, and you don't basically have to pay them for the use of the tax money. So tax deferral is the other way that you make money through stretch-out distributions. Two ways to make money.
Right. Now, I'm going to throw in another thing, and you mentioned the Roths. So the Roth, one of the changes that happens after a person passes away is, and we may get into this a little more later, but you actually have to take required distributions from a Roth when it's an inherited account. And Roths are special because whatever's accumulated in there is tax-free. So now you've got another benefit by being able to continue to invest the fund without taking the money out, because if you took the money out, you'd be putting into something, and whatever growth could happen would be taxable. Now it's not taxable if you defer for whatever remains in that account.
Right. So, for
Yeah.
example, with some of the larger Roth IRAs, I've had clients put those in a trust that go to grandchildren, and there's something called a generation skipping transfer tax exemption. That means no estate tax will be paid on that by not my generation, not by the next generation. The grandchildren get the Roth IRA free of income, free of estate tax. Now, I want to just put in a quick caution here. I've had this come up a couple of times in practice, and I'd like to warn your audience that we all have become very accustomed to the notion that when I'm alive, I do not have to take any distributions from my Roth IRA.
Right.
I've had a couple of situations where the beneficiaries who received the Roth IRA were told by the advisory team or some members of the advisory team that there are no minimum distributions from a Roth IRA, and therefore you, the children, or you, the grandchildren, don't have to take distributions out either. False. After I die, there are required annual minimum distributions from my Roth IRA beginning the year after I die. Don't miss it, because if you do, there's a 50% penalty.
Yeah, very nasty. So that's why you want to have inheriting an IRA, because they remind you that you need to take those distributions. Okay. Aren't retirement accounts handled as part of the process of probate or trust administration? Obviously, that's a baited question.
It's a baited question. IRAs, Roth IRAs, retirement plans, all pass by what's called a beneficiary designation. Essentially, those things are contracts. And the contract says that you get to say who's going to get it when you die. So those are things that pass outside of your taxable estate, and they pass outside of your trust if you've got a trust that's handling your estate. Unless, of course, you name the estate or the trust as the beneficiary.
Yeah, so not outside of your taxable estate per se, but outside of the estate as a taxable entity. Okay,
So what we're distinguishing here is that if I die without a trust, and if I die perhaps only with a will, then a probate estate gets actually open in a court of law, and all of my property gets administered under court supervision in my probate estate. And that's what you're talking about in terms of generally using the word estate.
Right. Yeah, so we have all these different definitions of estate for different purposes, and so it gets a little confusing, because when we say a taxable estate, usually where Mike and I would be thinking, I think, is about the estate tax return, and it includes items that would not be included in a probate. Okay. Why do retirement plans need to be considered soon after the participant dies?
Well, I alluded to that a minute ago. In fact, I said so, because there are required distributions.
Remind us.
So there are a couple of things that are important. Number one, generally, as I mentioned earlier, there have to be required minimum distributions that begin following the year of death. And if you don't take required minimum distributions, it is a 50% penalty. Let me add to that if there's some really good reason why that didn't happen, it's possible to ask for forgiveness of that penalty. So if that happens, you definitely want to go seek professional help, because you may want to, number one, file the form saying that the bad thing happened, and number two, you might want to ask for forgiveness because the IRS has the authority to forgive that penalty for what's called a reasonable cause.
Right.
The other thing is that in some cases, in order to get stretch distributions over the life expectancy of a beneficiary, you have to begin distributions by the year after death. And in some cases, if you don't do that, you only have 5 years to take it all out.
Mm-hmm.
And that can only happen if the decedent died before reaching the decedent's own required beginning date,
Right.
which in Roth IRAs is always.
Right, okay. So let me throw this out as well. What if the decedent was over age 70 and a half, the required beginning date, and they hadn't taken a distribution yet for the year of death?
Oh, if they haven't taken the distribution for the year of death, you want to get that out on time.
Yes.
For the very same reason. And the questions that come up about that make that a little bit complicated is, well, so the decedent had a final required distribution to take out. Do you have to take it out? Yes. The follow-up question is once it's taken out, first of all, who has to take it out?
Yeah,
And the answer is the person who is the beneficiary of that plan.
right.
So if it's the surviving spouse has to do it. If the beneficiary is the trustee of a trust, the trustee has to do it. If the beneficiary is a child, the child has to do it. The next question is, who pays income tax on that if there is taxable income? And the answer is the beneficiary.
Mm-hmm. Now there's another reason for thinking about it soon after death. What if you have, let's say I've got an IRA and I have beneficiaries, 50% of it's going to my children and 50% of it's going to a charity.
Okay, so let's go through that one. The required distributions, there's a date that's real critical for that in terms of when you fix who's going to be the measuring life for each of those things. And there's two rules to look at side by side. So one of them is that if you distribute out the charity by September 30th of the year after death, you don't have to consider the charity in terms of figuring out how those required minimum distribution works. And that's a good thing because a charity is not an individual and the IRS gives you a bad result for that reason. The other thing that you keep in mind is December 31st of the year after death, because if you divide the IRA into shares for the charity and each of the two children, I'm assuming a third, nobody has to worry about the other one's doing. So there's two rules that can get you out of the box.
Yeah, so we can divide the IRA or we can eliminate a disqualified beneficiary in order to do the stretch out again that we were talking about, have the required distributions made in small amounts rather than having to take everything out in a lump sum.
Yes, and there's one other critical date. I have a client right now who is going to, who doesn't want his piece of the IRA. He would like it to go to his children.
Ah,
And it turns out that the IRA beneficiary form actually says that if he died before the IRA owner did, it does go to his children. How does he get it to them? He does something called a disclaimer. And that has to be done within 9 months to the day of when the decedent has died. You do need legal help with that also so that the disclaimer qualifies under state law.
yeah. So what I'm really trying to emphasize here, folks, is that some of these things, you can see we've got a very short window of time to act. And so you need to, I'm not saying, right after death run to your attorney's office, but it's something that you don't want to delay for a real long time. And sometimes when somebody passes away in your family, some people go through some, real emotional issues, and it's hard for them to deal with this. But, give yourself a little time to mourn. You deserve it. But on the other hand, be aware that these things do require some attention before too long. Okay. Who is responsible for being sure that the administration of a retirement account is handled in a timely manner?
Generally speaking, it's going to be the beneficiary.
Yeah, and the beneficiary may not know that they're a beneficiary.
This is a problem. So may I take just a second here
Sure.
to remind the folks, everybody, who has an IRA or who has a qualified retirement plan or has anything that involves a beneficiary form, could be a life insurance contract,
Okay.
please review your beneficiary forms annually. Not only because people's name change, because sometimes they get married and the name changes, and so therefore it's hard for them to be identified by the IRA custodian or the plan administrator or the life insurance company, but also because these people move from time to time and their addresses change. So it's a good thing to annually review your beneficiary forms to make sure they are current, and then not only make sure that this information is in the hands of the IRA custodian or whomever it may be, but to make sure that it got into the computer system correctly. Ask them what they have in the system. Ask to see that, and you'll get correct and accurate feedback about where that's really going to go.
Yeah. So another thing is that I found, unfortunately, sometimes these custodians aren't really forthcoming. And so,
Well, they don't have someone's address, or they don't know how to get a hold of someone.
yeah, or
And
they
what-
may not even know that the person's passed away.
Well, and if somebody doesn't claim property after a certain amount of time, the custodian eventually has to turn it over to the state of California, and it's listed as something, or whatever state you're in, because I think all states have this. It's called escheated property. And there are lists of property that will revert to the state. If you don't get to it on time, you're going to lose it.
Okay. We only have about 4 minutes left, Mike, just to let you know where we are. So we're just going to hit a couple of major things here. One of them, I think, is a very important one. Should a surviving spouse immediately roll over or convert an inherited IRA or retirement account to his or her own name? Because this is the one where they get the bridge club advice or the hairdresser advice.
So let me go through where the trap is in that. Let's say that the surviving spouse is, we've had this come up, is say about 45 years old. It was sort
Right.
of a tragic and young death.
Yes.
The surviving spouse then is got an IRA coming from the decedent spouse. If the surviving spouse leaves that IRA in what's called an inherited IRA and does not roll it over, then the surviving spouse can take out what the surviving spouse wants to and pay income tax on it. On the other hand, if the surviving spouse rolls that IRA over to the surviving spouse's own IRA, because the surviving spouse is under age 59 and a half, distributions before age 59 and a half are going to be subject to a 10% early withdrawal tax. And so it may not be the best thing to do in all cases.
Right.
It's a very good idea after the death of a surviving spouse to just sort of leave things where they are and seek help. And in my example, what we have done in one case is we had that surviving spouse work with a financial planner to determine about how much is that surviving spouse going to need before age 60, and maybe be a little generous and leave that in an inherited IRA. And then let's roll over the rest so there's some incentive not to spend it because of the 10% penalty tax.
There you go. Now, also bear in mind, though, that you can convert this later. So initially, she may have it as an inherited account, but then, let's say after she's age 59 and a half, could elect to roll over at that time.
That's a very good point.
Yeah. Okay.
In either case, the surviving spouse should consider who the next beneficiaries should be and fill out those all-important beneficiary forms for the inherited IRA.
Okay. Let's talk a little bit about Roth conversions for a couple of minutes, and a minute. Boy, not much time. But there is a lot of buzz, people talking about Roth conversions. What can be done related to this? Let's say I've got a 401k that I inherit. Can I convert that to a Roth?
That's a great question. In 2006, we had a tax act passed that said that what can happen is that if I inherit a qualified plan, which means the employer variety, employer-sponsored variety, I have the right to take that money and put it into a Roth IRA by direct transfer, and therefore pay the Roth IRA conversion tax on that money, or I can take it in as an inherited IRA, either one. And the plan administrator is required to give me a notice telling me I have those rights. I like to see people take the Roth IRA route in all cases because you have until generally October 15th of the following year to change it to a traditional IRA if you didn't like the Roth IRA answer. But you can't go the other way. It's a one-way door. So I get a free look at both options by starting out with the Roth.
Okay, but if you did the transfer initially from the 401k to an IRA,
It's an inherited IRA, and you cannot turn that into a Roth IRA ever.
right, okay. So I wanted to remind people about that. Okay, Mike, I think that's about all that we have time to cover today. Again, I want to thank you again for being my guest. Remind our folks again at home, Inheriting an IRA is Mike's book. You can get it at Amazon.com, but Mike also has a site dedicated to it. It's called inheritinganira.com, right, Mike?
Correct.
Okay, and you can actually order the book at that site. Folks, hope we've given you some things to think about, and also hopefully give you a sense of urgency of getting some good advice, and don't act too fast after somebody passes away. We'll see you next time on Financial Insider Weekly.